All right. David, good to have you here too. Okay. Listen, welcome everybody. Good to have everybody here. Got a good looking crowd here for this afternoon session with Melissa Frasier. Those of you who have worked with Melissa, she hardly needs any introduction. If you haven't, well, you're in for a treat. We periodically like to bring you up to speed on, hey, what are those options that I've got available? And we do live in a very dynamic market environment as it relates to long-term care or extended care product solutions that we've got available. So that's the spirit of today's session. Melissa is going to give you the straight skinny on just what are the options that you've got available out there. Is it what's going on with traditional long-term care insurance? What are some of these other products that I keep hearing about? She's going to tell you everything you need to know, and she's going to do it in a fairly short period of time because we try to keep everything to 45 minutes. But I hope she doesn't promise to do that because if she needs to go a little longer, it'll be well worth it. So, just from a housekeeping standpoint, as we usually do, we got all the lines muted, but that doesn't mean that Melissa doesn't want questions. So go ahead and type those in. If you do have questions, go ahead and type those into the Q&A section of your control panel. We'd love to hear those questions from you. We'll take a look at them at the end as opposed to like hitting each one as it might come up. And I'm sure you're going to have some questions. So we'll take all those questions at the end, as I mentioned. We're also recording the session. So hopefully everybody at this point knows that we try to archive as many of these sessions as we can out at our website, which is advisorsib.com. You can see it at the bottom of Melissa's title slide here. So if you go to advisorsib.com, there's a tools and resources tab at our website. And if you go in there and you go to archive training, you can find all of our recorded training that we've done here recently over the last, I don't know, year or so, maybe a little longer. And this too will be added to it. Usually takes us a couple of days to get it reformatted and optimize it and get it up on that website. But take a look at it, give it a listen, share it. This session or any of the other sessions that you find out there, don't hesitate to share the link with any of your colleagues who you think might benefit from hearing from it. So you're in for a treat today. Melissa always does a terrific job. A lot going on in the long-term care space. As Melissa will tell you, we're having a super long-term care year this year. Our business is way up, which means that there are a lot of these conversations going on, which is no surprise. Long-term care or extended care planning is on everybody's mind. And know that you've got us in your back corner or in your back pocket, I guess I would say, as that resource to help make sure you're making the appropriate solutions available to your clients and your prospects. So, Melissa, great to have you here as always. With that, I'm going to go ahead and turn it over to you. Go ahead. The floor is yours.
Awesome. Thanks so much, Bob. And thanks everyone so much for joining me. First and foremost, I want to ask for just a smidge of grace because I just created this fresh PowerPoint. So I've reviewed it a little bit, but I'll do my best to certainly make a lot of sense out of this for you. So, we definitely want to chat about the various long-term care solutions. Back in the day, it was traditional standalone long-term care. And today we've got some really awesome solutions that are bridged with life insurance, even annuities, outside of the state of New York, and a solution for folks that may not qualify medically or due to age. So we're going to take a deep dive into some of these plans. I'm going to go a little bit rapid fire through these slides just for sake of time for everyone. But please know, and I'll mention this at the end as well, my colleague Jennifer Brown and I, we are not just your quote girls. We want to do anything and everything we can to help you make that case come to fruition, help your clients secure that valuable long-term care protection. And so, anything from a conference call to Zoom meetings, Jen and I do them all week long, and we really can be that resource to help you present these solutions to your clients. So just know that this is a broad brush overview, but we can take a deep dive as you have your next long-term care opportunity for sure. So with that, it's certainly not a question of if you're going to help your clients, plan for a long-term care event, but how, and which solution might be best for them. So a few things you want to think about when it comes to the importance of long-term care planning. We're all living longer. We're living longer. The odds of long-term care are certainly far greater than they used to be. When I got in this business, October of 96, well, almost 30 years for me. Woo! I started when I was 8. No, all kidding aside. when I got in the business, it was like a 50-50 chance that you might have a long-term care event. I remember that statistic loud and clear. Well, with advances in medicine and technology, people are living longer and they're actually lingering longer too. And now, once you reach the age of 65, there's a 70% chance that folks are going to require some form of long-term care services. Costs are definitely outpacing general inflation. The cost of care is staggering. I know we never want to go into a facility, but in New York State, I'll give you just some stats for New York State specifically. Nursing homes on average, and this is the whole state lumped together, average between $15,000 and $16,000 a month for care in a nursing home. That's just the median cost between a semi-private and a private bed. So what does that equate to? If the average length of a long-term care claim is 3.2 years, my word, that is like a $600,000 potential hit in today's dollars to one's estate. But wait, what if you don't need this for 20 years from now? And if we assume on average a 3% inflation to keep pace with that, now you're looking at over $1 million, $1.1 million per person. So to a married couple, oh my God, I know it's the worst case, it's the nursing home, but they could face up to a $2 million long-term care exposure. And the question is, are they prepared, to fund that themselves, or are they better off, transferring some of that risk to an insurance company? As far as the solutions, we're going to dive into a few of them today. We're going to talk about traditional long-term care, the linked benefit solutions, not really going to brush too much on hybrid life, because that's really more of a life insurance solution. We'll just kind of gloss over that. And also that True Freedom product for folks that may not, qualify, as I mentioned, for an underwritten product. So here's just a quick little slide I put together of, what type of solution might be best for my client. If you've got that client that is really cost conscious, maybe they want to spend, $2,000, $3,000, $4,000 a year. Most of those clients, you'd probably, quickly determine might be a better fit for traditional standalone long-term care. You definitely are getting the best bang for your buck in those policies. And, the downside, I'd say that potential drawback is, as many of us know, traditional long-term care plans, they sit on a health insurance chassis. So are they subject to a potential rate increase, or rate increase is? Yes. Now, to address the elephant in the room, while it certainly can happen, unlike the carriers of yesterday that made some horrendous assumptions, the lax assumptions, they had unisex pricing, there's so many things that worked against them. Plus, many of the companies that were heavy hitters back in the day, the Travelers, the CNA, Hancock, Genworth, Fortis, etc., they're not in the business anymore. So they don't have current revenue to offset that claims experience either. So a company such as Mutual of Omaha, which I'd certainly say is our leading traditional long-term care carrier, they've been for 12 years, they've had gender-based pricing. Female rates are quite a bit more, 40 to 50% higher than male rates are. And that's because statistically speaking, that wife will be able to help her husband, he typically claims first, with some level of his care, minimizing the out-of-pocket. Usually that male stays home. So a chunk of that pool of money for the husband may not be needed for a long-term care event. Whereas for women, ladies were a little bit of a sitting duck because who's going to be in the home to help take care of us? And so, we typically need care instantly. And if anyone's going to walk into a facility, it typically is us ladies. And actually I went through this about 3 years ago before my gram passed. I spent a good deal of time over the course of a couple of months in a local nursing home in the Albany, New York area. And what I've heard forever is so true that, the residents of a nursing home are 10 to 1 women. So female claims, are definitely far more costly to the insurance companies than male claims are. So I think that's important for you to be aware of when you're looking at quotes that we've done when we go through this presentation. But now we have gender-based pricing. So that risk that really sat on those old policies because they were unisex pricing isn't so much there. So the rate increases today are far less frequent and much less than what they were years ago, if that helps. The linked benefit policies, they're best for those clients that want the guarantees. The big ones is that there's a death benefit. If I pass away and never touch it, I'm going to get what I've paid in, if not more than what I've paid in the form of a death benefit. And those premiums, they can't go up. They're fixed. And the ability of cash indemnity. And we'll get to more, we'll get more into that in just a few minutes. The potential drawback there, yeah, are the premiums higher? Sure, because those guarantees do come at a cost. So we have to know our audience there. The life policies that have purely an acceleration for either long-term care or a chronic illness rider, those are going to be better suited certainly for those that have a life insurance need. They're going to be heavier on the death benefit and a little less robust on the long-term care side of things. And then the True Freedom product, that is again, the guaranteed acceptance, sorry, one second. That is a guaranteed acceptance discounted home care program that's available. Now I use the words guaranteed acceptance a little bit cautiously because you do have to be able to pass a couple of quick questions. And one of which is that you're able to live independently in your home today and don't need any help with any of your activities of daily living, and you haven't been diagnosed with a progressive medical condition. There is some self-funding, so it's not perfect, but we will get to that a little bit more as we proceed. So let's chat real quick about traditional standalone long-term care. Some of the pros, and some of this is a little bit redundant, but yes, it's certainly going to be the least expensive option for long-term care. Long-term care policies, certainly traditional ones, are very advantageous because there are tax incentives. So New York State specifically has a very generous 20% state tax credit, which in essence is really a discount that they're going to get each April off their long-term care plan. And the real sizzly part is the federal side. So when you've got clients that own a business, a huge chunk of their premiums, if not all of it, may qualify for a federal deduction. I'm not going to delve into that right now because it'll derail us a little bit too far, but please, if you know that you've got a client, and it doesn't even have to be, Mr. Big C Corp, S Corp, partnership, LLC, self-employed, sole prop, that you're working with a client that owns their own business, definitely let Jen and I know that, first and foremost, so we can let you know how that's going to help those premiums. And there's also partnership asset protection in most states, not New York, Connecticut, California, or Indiana, but most states otherwise, yes. And what does that mean? That means if I start out with a policy that may have a $200,000 pool of money today, and in the future it has, say, $400,000 is the value of my pool of money then, and I were to use my long-term care policy, exhaust my $400K, what I in essence have is, let's say in New Jersey, in the state of New Jersey, their Medicaid program would say, okay, Melissa, because you bought a policy and it was partnership qualified at $400,000 worth of benefits, we're going to allow you to keep $400,000 of your assets, and you just need to spend down to that dollar amount. So again, I don't want to get too deep into partnership qualification, but that's a really nice feature because for those clients that don't have extreme wealth, and that $400,000 of asset protection is a real thing for them, well, now it's super because not only are you getting $400,000 of insurance protection, but you're getting another $400,000 of asset protection. So God, that's $800K per person in essence. So it's an extremely attractive feature in those states that offer a partnership program. The cons, we talked about rate increases, and obviously it is a use it or lose it proposition. But again, 70% of us, once we reach the age of 65, will have a long-term care event. So it's certainly quite likely. So let's take a look at some of the nuts and bolts in the Mutual of Omaha product. Again, I'm going to gloss quickly for us for sake of time. It is an expense reimbursement chassis. So you do have to use credentialed caregivers, as the second bullet here shows. Any aide, nurse, therapist that you can scratch up. They can be private or independent, and they don't have to be employed by a home care agency, which is nice, but they do have to be credentialed to get the full benefit. And you would, yes, submit your receipts to get your money back for your actual cost of care up to your monthly benefit. Monthly home care and calendar day elimination period are both baked into the plan. And keep in mind, there is a partial cash feature. It's small. So 25% of whatever your monthly benefit is come claim time can be elected in lieu of bringing in a professional. So maybe in the beginning, the wife is like, yeah, honey, I got this. I'm not ready to bring in an outside provider. Can I just do it? Can I just help? And so maybe for the first handful of months, that wife is like, yeah, show me the money, pay me that cash feature, and then you can flip to reimbursement to get the full benefits whenever you're ready to do so. Very flexible inflation options. Love that about Mutual of Omaha. We can buy as little as 1% compound all the way up to 5% compound in any quarter percentage interval. And we can put a shutoff valve on the back end of the inflation. We can tell it to grow for 10 years, 15 years, 20 years, or grow indefinitely. That is a massive game changer. It allows the premiums to really plummet when you've got folks that are of age appropriate. Like, for example, a 60-year-old, okay? I would do a 20-year cap on that 60-year-old. Average claim is around the age of 80. And the difference between capping that, say, 3% compound at 20 years compared to doing, say, 3% compound that's lifetime or indefinite, that's about a 20% savings in premium. So it is pretty sizable and very customizable. You know, you can add shared care where you can share your pools of money. You can waive your elimination period for home care, survivorship, return of premium, joint premium waiver. All these great little features are certainly available. So that's nice too. Let's look at a quick case study. I took a 60-year-old married couple. This happens to be a New York case. I solved for $6,000 a month. Okay, I realize that's not going to cover the full risk of nursing home care, but I can tell you there's nobody buying $10,000, $12,000, $15,000 a month. It's just not affordable for the average client. So what does 6,000 represent? That's a good 6-7 hours of home care every single day. And here's a great stat. 80% of all claimants never leave their house. And that statistic for men is actually 91% of men. Again, why is that? Because their wives are helping them, stay at home, which is super. So we tend to look at $5,000, $6,000, maybe $7,000 a month, something in that ballpark. So for this quote, I use $6,000 a month. I solve for the average claim, which is 3 years. Remember, you're not really buying time. You're buying a pool of money. You're buying this big old bucket of money. Because if I only needed care a few hours a day, and I only needed $3,000 a month, that 220,000 pool could last twice as long. It could last literally 6 years, because it's not over until every dollar of my long-term care bank account has been depleted, regardless of how many years that may take. So just be aware of that. Normal average health, 90-day wait, which is pretty much an industry standard. And for this couple, because they're 60, I use 2% compound that would grow for 20 years and freeze. So as you can see, premium here, 3, 4, 5, $5,600 a year combined. However, if this couple qualifies for the 20% New York State tax credit, which the one caveat is their AGI does need to be below 250,000. That's important. But assuming they are below 250K AGI, that net premium would be 4516. So this is kind of what I do with clients that I present to. I say, okay, Mr. or Mrs. Clients, 4516 is your net premium. If you were to pay that 20 years and go on claim at age 80, very typical. How does the math work? You've paid 90 grand in bite-sized premium payments. At that time, you'd have 89.13 a month, 327 grand each in your pools of money for long-term care. So for 90K, you're creating 654K of aggregate long-term care coverage. How else are you going to produce that kind of a return, on your investment? So here's a New Jersey couple. Okay, I decided to look at one that is partnership qualified. So this is a 60-year-old married couple. Here, partnership qualification does need to be for life. So there's a cost to that. Some states will let you do a 20-year cap and have it be partnership qualified. In New Jersey, you can't cap it. So the premiums are a little bit higher. As you'll see here, all the benefits are equal. And so again, that in this example, they had the 327K, as we talked about, followed by another 327K by New Jersey Medicaid would be protected. So as I was alluding to before, wow, look at that. For this married couple, that's really $1.3 million of aggregate total long-term care protection. And then I said, you know what? Let's take a look at the application for somebody who is young. Normally, we don't get real, excited about looking at couples that might be 40 or in their 40s, but let's show you how reasonable this thing could be. Here, I went a little bit more conservative. I solved for $5,000 a month, again, a 3-year pool. And here's what I did here. I did a 1% compound inflation rider. Okay, we have to be careful with people who are this young. They may not have several grand apiece to be able to put into a long-term care, policy. They have bigger fish that they're frying. They've got children getting ready for college, things like that we have to be cognizant of how much today that available income might be to be able to fund long-term care. But here's what's really cool. If you did a 1% compound inflation, and again, you take this 20% New York State tax credit if they qualify, their net premium collectively is only $1,755 a year. And what's really cool is if you buy Mutual of Omaha's inflation, any inflation percentage, it comes baked in with a buy-up provision. And buy-up essentially says that if you buy it today and down the road, each anniversary, you're going to get an offer to bump up your inflation with zero medical underwriting, none. So they can't ask a single medical question of you. It is guaranteed acceptance, so to speak. And you will pay a little more, fairness, because if you're going to go now to 2% compound 5 years down the road, or 3% compound, you're older. So you're going to be paying just that little portion of your inflation, additional inflation at your current age at that time. But what you've done is you've locked these folks in so that most of their premium is at the age of 40 forever, which is super, as opposed to waiting and coming back to you in 10 years to talk about long-term care. And the other side of it is, again, they're locking in their insurability, but also this product, let's face it, 5 years from now, we know it won't be on the shelf anymore, right? Had they waited just even 5 years and came back to you, I can promise you there's going to be another Roman numeral on the end of this product. And new purchasers are going to pay a higher price tag for that naturally. The last time Mutual of Omaha had what they defined as a rate refresh, on average, the premium was like 28% more for new people. So when people say, what's the right age? What I tend to say is, hey, the average age for long-term care is 56. However, there's no being too young. The younger you are, the cheaper the premium. We're never going to be healthier. you're far more apt. I didn't even take into account that this couple could come back preferred, which is a 15% reduction on these rates. So it certainly can be extremely affordable. So just be aware of that. Okay. Now let's jump into linked benefit a little bit. Some of the pros and cons here, your premiums are guaranteed. And so it sits on a life insurance chassis. So your rates can never go up. It's the gospel. And I'll show you a great page within a nationwide illustration that really shows that very well. Death benefit, as we talked about, typically there's a 10% residual death benefit if you were to erode the death benefit for your care. Cash indemnity, we're going to peek at Nationwide, and also Bright House. They're full cash indemnity. They're just going to cut you a check for the month, and you could do anything you want to do with that money, which is fantastic. You have the ability in really most all states. You can do a single premium, yes, 5 pay, 10 pay, pay to age 65 or 20 pay, depending on the company and product. And all states now have a pay to age 95 or pay to age 100, which is really cool because it kind of mimics what a Mutual of Omaha, may look like, which is super. And certainly 1035 capabilities. Do you have that life insurance policy that you just really don't need any longer, and it has some cash value that we can dump into this solution for long-term care? We do, Jen and I quote that all day long, which is fantastic. Some of the cons, are the premiums going to be higher? Sure, definitely higher for those guarantees on the life side. Your tax incentives still come into play, but only on the portion of the long-term care premium. So you'll see on the illustrations with most companies that they're ridered out. So here's your life premium, here's your long-term care portion of the premium, and it's the long-term care piece that would be eligible. And we'll look at an example of that in a moment. And because they're life insurance chassis, there wouldn't be any of the partnership dollar for dollar asset protection. So the Nationwide Care Matters 2, that's going to be our case study. I think Jen would agree with me that really it's our go-to. Most states, they're going to give you the best bang for your buck. But that's why we just picked on, Nationwide for today's purposes. So it happens to be a UL chassis. Yes, it's a full cash indemnity informal care plan. Again, premiums are guaranteed, death benefit, you can surrender it, but really people don't surrender these policies. Why? Because these really aren't your earmarked life insurance solutions. In fact, here's an important distinction. I get very often that, this is kind of cool, Melissa. It's kind of a 2-for-1 that I've got life insurance and long-term care. And I have to correct them and say, be careful. No, you don't have long-term care and life insurance. You largely have an either or proposition. Because what's happening is in the first 2 years with these products, what you're doing in essence is your care is being depleted from the death benefit first. The first 2 years is an acceleration of the death benefit. So if you needed 2 years or more of long-term care, in essence, you don't have a significant death benefit. Again, most times it's about 10% that you'd be looking at as a residual death benefit. Okay. Payment options, we talked about those already. The elimination period, this is a really cool feature. With Nationwide, if you go on claim on, say, January 1st, okay, you've got a 90-day wait ahead of you, and your family can be helping you, that whole time. Once you get to the end of March, and now you're sitting at April 1st, come April 1st, they're actually going to cut you a check for 4 months. They're going to go retro back to January 1st, give you those 3 months of your monthly benefit to you, plus the month of April. So right out of the gate, you're going to get 4 months. So that's pretty awesome. It's going to help offset any of the expenses that we may have incurred during that waiting period of 90 days. Okay. So here's an example. Here is a New York couple, age 60. In this one, I solved for the $6,000 a month again. a 4-year benefit. We can do typically 4 or 6. Some go with the 6-year. It's not that much more expensive to go 6, but I was trying to make it a little closer to the Mutual of Omaha. So Mutual of Omaha was a 2% compound. They don't offer simple, but 3% simple grows pretty similarly, I would say, to the 2% compound. And I did their pay to age 100. Okay, so look at how affordable this can be. You know, for this 60-year-old married man in New York, it's a $4,400 a year premium that he would make. You're going to see these by the way, this is their tabular detail page. I believe wholeheartedly this is the secret in the sauce. This really breaks everything out, you know, really, really well of all the pages in the illustration. So these are the light blue is your life guarantees, right? Your cash value and your surrender, your death benefit. This is your monthly benefit for long-term care, complements of the inflation, and this is your pool of money. Where's your pool of money going to be then? Okay, don't forget that the long-term care portion's getting that 20% New York State tax credit in my example. So the premium is more like $4,000 a year once you factor that. Remember what we said earlier too, female rates are more expensive. Beware, females would be about $6,100 compared to $4,400. So it is a little higher. And there is certainly a savings if you were to do it in fewer payments. So single pay, 5 pay, 10 pay, just to give you an idea on this example, what those premiums would look like for this married male who is 60. So what I like to do with clients is I go right down here and I pretend the client is age 80. And I say, okay, Mr. Client, at the age of 80, you've paid what, about $94,000 in to your premiums, the 89K plus one more year. So you've paid 94 grand in, but you know what? If you were to pass in the night and never touch it, Nationwide's going to send your beneficiary 144 grand. So certainly much more than what you've put in is what you'd get in the form of a death benefit. And if you have a long-term care event, they're going to cut you a check for $9,600 a month cash. Do what you want to do with that money. And your pool of money would be $473,000 and change. Remember, he's paid about $94,000 in for 144 minimum or up to 473K in benefits. So this is kind of a live, die, or quit. One way or the other, Mr. Client, you are going to get your money back. So it's guaranteed that, you know, it's not a use it or lose it, such as a traditional long-term care plan. So then I said, well, what about we look at a young married male, age 40, similar to what we looked at with Mutual of Omaha. Still not bad here. Okay. This guy, all specs are the same, $2,100, but he'd be at about $2,000 if he was able to take that New York State tax credit. Female rates, remember, a little higher, 25-30. Here's your accelerated pay options up here. And same kind of scenario. You know, this man would pay about $88,000 in bite-sized premiums total, 120K death benefit, and over $500,000 of long-term care cash at 11K a month. So super compelling, you know, for sure. And then finally, in the linked benefit side, I said, let's look at a couple that is on the Care Matters Together chassis. So outside of New York, sorry to our New Yorkers, but outside New York, there is a second to die joint policy called Care Matters Together. It's a little bit busy, but this will give you some perspective. Again, I did a pay to age 100. I did 3% compound that will grow for 20 years, which is age appropriate in New Jersey for sure. And so this is the combined premium. So through the age of 80, might be a little bit cut off here, but you'll see $10,430 is the premium every year. So they've paid collectively $218K in total premium. And in essence, they're going to get just about their money back, $216K. Sorry that it's cut off a little bit on you. But their long-term care pool And their monthly benefit, if we come over here to these columns, $10,837 is the monthly benefit in 20 years' time. And the total long-term care pool is $780,000. So considerably more, almost 4 times what they put in premium they'd have available in the form of long-term care benefits. So again, this tabular detail page is super. It really kind of breaks through everything for you. I won't spend more time on this just so we can get through what we have to get through. But Jennifer and I can certainly spend time as you have your next case and you're looking at linked benefit. The players for linked benefit, certainly we're talking about the Care Matters 2 and Care Matters Together with Nationwide. Again, only individual Care Matters products available here in New York. Bright House has a smart care product, very similar. One America, the same. Lincoln Money Guard, Fixed Advantage. Equitrust has a bridge product. So both Equitrust and One America do have an annuity linked benefit product as well. And we do, of course, have a number of life insurance products that have acceleration riders for long-term care or chronic illness. And let's just take the next 5 or 8 minutes before we open it up for questions. And let's take a peek under the tent of True Freedom. So it's a little clunky. There certainly will be questions on this. We'll go through it in a little bit rapid fire fashion. But that said, we have an 8-minute video link that goes through top to bottom the True Freedom product, and how that program works. And we can certainly send that out to you if you want to get a little bit more familiar with it. I think most, if not all of us, have had that client that either is over the insurable age for long-term care, which inside New York is 75, outside New York is 79. We typically don't have a solution for them, or they've been told they've got, they're not eligible for any underwritten solution due to a health concern. And so as I mentioned before, as long as that client can live independently, can do their activities of daily living, and hasn't been diagnosed with a progressive medical condition, so they're fishing for Alzheimer's, MS, Parkinson's disease, things like that, then they would qualify for the product. There's no age limits, no medical underwriting. A couple great things. There's no benefit triggers. There are countless people that may pass and they didn't quite make that 2 out of 6 activity of daily living trigger, or they've got a little bit of cognitive, but they haven't reached that severe stage. You can request your benefits on True Freedom, frankly, because you feel like it. And it's not just for, long-term care assistance or ADL assistance. It is meal prep, chores, grocery shopping, take you to your medical appointments. So it's really could be the IADLs and not just ADL assistance. They also encourage informal care. It just can't be your family or anyone who's residing with you. But if you've got, a friend, a neighbor, a housekeeper, the girl from church, somebody that you love and trust who may not have any credentials, thumbs up. True Freedom will allow that person to be your caregiver. They do use reasonable and customary. So as far as the costs go, so it could be $15, $20, $25 an hour in the future. Hard to say, but that's what they use for the hourly payable amount to somebody who is not credentialed. They also do have a network of thousands of home care agencies across the country. They're all part of their program. And certainly you can use agency care. Agency care is limited Monday through Friday between 9 a.m. and 5 p.m. and no more than 5 hours a day of agency care. There's no elimination period. So if you enroll today and a year from now you need this, benefits are paid immediately, so long as you are at least 90 days from when you request your benefits. So if I enroll today, I've got to be at least 90 days out before I request benefits. There's no lengthy claims process or paperwork. It literally is one piece of paper is the enrollment form, which is super. There are 4 different programs. So we'll take a peek at that in a second. There's platinum, gold, silver, and bronze. So there's a program to meet really anybody's budget. And they reward you for not claiming instantly. There are a discount of 10% each year for 4 years that you're going to get off. So once somebody is 4 years deep, your enrollment fee has lowered by 40%. And there is a 5% discount if someone pays annually, and there's a 10% discount when a couple both enroll for coverage. So you could get 10% for a married couple plus 5% if you pay annually. So a 15% reduction in cost. It is a commissionable product to you, which is super. It's a 40% first year commission and a 5% renewal every year that the client is not collecting benefits. I alluded how this is a discounted home care program. I also would be remiss if I didn't say there's no facility care here. So they're not going to cover assisted living or nursing homes under this program. So I wanted to blow this up so it was big, but it's a smidge blurry, so forgive me for that. The platinum plan sits up here on the top. And in essence, the way that it works is you would get, I'm going to pick on the gold plan. Let's do that. This is platinum, gold, silver, and bronze. And you can see the costs. The highest Cadillac here is $5,400, but if you do it with your spouse and you do it annually, it's $4,800. And then it could be $3,000, $1,700, and just under $1,000 down here if you were to do the bottom plan, the bronze plan. Let me give you a quick example of how the gold plan works. So this is because I'd say the lion's share of folks, kind of the sweet spot. A lot of folks feel comfortable with around a $3,000 a year cost. So True Freedom, let me back up, is not an insurance product, okay? It is a discounted home care program, kind of akin to being a member, if you will, of AAA, okay? And they're giving you these batches of thousands of home care hours that you can utilize in your lifetime when you need them. Now, because it is largely guaranteed acceptance, you have to figure there's going to be a push-pull. What's the catch, Melissa? It seems too good to be true. And essentially, here's the catch. They're not going to go, all right, Melissa, here's your 6,000 home care hours. Have at it. They're going to ration them. So if I request my benefits, they're going to give me 10% of my lifetime hours at a clip. So in essence, 600 hours is what I'd have. And they'll say, here you go, Melissa, here's your 600 hours, ready, go, use them as fast or slow as you see fit. So the long-term care brains that are on with me, you know, in the early stages of us offering this program years ago, they'd go, Melissa, help me out. How long could 600 hours actually last me? So I did all the math for you. And I said, all right, what if we needed the average home care shift, which is 4 hours a day? What if we needed 4 hours of home care every single day? How long would 600 hours last? The answer is 5 months. So what happens is if I'm in that pool and I use my 4 hours a day, I'm 5 months deep. Now I still need care, but I've run out of my 600 hours. What they essentially do is they hit the pause button. They're going to hit the pause button now for 90 days. So you're going to self-fund or have loved ones help you for the next 90 days while you're on pause. Then they're going to go, here you go, Melissa, here's 600 more. Hit the pause button, and so on. But it really isn't horrendous because let's think of it in these terms. Let's just take the first calendar year that we're on claim, you know, with True Freedom. In this example on gold, if it were 4 hours a day, in essence, the clients were covered January, February, March, April, May in the calendar year. Then they were on pause June, July, and August. And then True Freedom was on the hook for September, October, November, and December. So just in that first calendar year, 9 months was picked up by True Freedom. And if the cost of an hour of care, let's say is $25 an hour, let me get my calendar, right? $25 an hour. And the future cost when a client needs it, I don't know, let's say it's $40 an hour then. If we take $40 an hour and we multiply that by 6,000 hours, what's the value potentially of having this program? The value is $240K. In my example, if that $25K today, $25 an hour today became $40 an hour tomorrow, that's really what that value is. So while I wish we didn't have those pause buttons, by all means, the reality is until you broach the conversation to that older and or uninsurable medically client, until you broached True Freedom with them, how much of their care were they prepared or going to have to be prepared to self-fund? All of it. So being able to transfer the risk of $240,000 in my example to a plan B, to True Freedom, I think is certainly very, very worth it. And remember what I said. So in this example, if a married couple were to do it and they're also paying annually, that cost is $3,000. But remember, it's going to drop. It's going to drop each year that they don't file a claim. So in year 2, it's $2,708. In year 3, it's going to be $2,400. And then so on and so forth. So once you've hit 4 anniversaries deep, it's a 40% reduction in their enrollment fee. And it would freeze there until they need it. Once you do request your benefits, you're going to lose that non-usage discount of 40%, and it would just go back to what your enrollment fee was then. Okay. Remember, this is not insurance, so there's no premium waiver, right? Because we're not paying for a premium here. We're paying an enrollment fee. It's kind of like if you have a collision with your car and they come and tow it away at AAA, you still have to pay for your membership within that program. Same sort of, situation here. So it really has its place. I can certainly share that video with you all. I know this program backwards, so I can always jump on a call or do a Zoom, by all means as well. I'll just leave you with a couple fast things and then certainly out of time, but pre-qual. Couldn't tell you enough. It's super important to take a peek under the hood and know exactly what we're dealing with medically with our clients. We have a very simple 1-page fillable pre-qual health form that we can email over to you. The clients can take 5 minutes. They can type in their information, and Jen and I can take a quick look at that and go, okay, this product is good for them. This product is not, or they might be rated up, and this is the likely class. We definitely want to know before you get halfway through an application and you've already presented a particular product that it's right for them. The last thing we want to do is overpromise and underdeliver. So that pre-qual form, I like to have that. We like to have that before you even get quotes. So at time of quote, if you shoot us over that pre-qual form, let us work for you and let's make sure that we're quoting viable protection for folks. Product training, be aware of that. Depending on the states, there is product training involved. In New York State for Care Matters, for example, you do have to have a product course on Care Matters. It's a very simple thing. We can send you the link over to do that. That's before an application comes in. Outside New York, in most states, there is a long-term care certification course. It's an initial 8-hour course that you take online, followed by a 4-hour refresher every 2 years thereafter. Do not ever worry about taking your CE and paying the cost for it. Just come to Jen and I, and we can provide you with a complimentary voucher so that you can take that needed CE online at no cost to you. Which is best? It depends. But I hope it gave you definitely a little bit more insight into the various solutions that are available. Remember, we don't just do your quotes. We can help you design, a plan of care for our clients. We pre-qualify all the long-term care solutions. Come to Jen and I. We are going to pre-qual, and if we're not positive, you'll see that we're going to go to one of the insurance company, underwriting managers, and we'll pre-qual it directly with them so we don't have any surprises. And remember, lean on us for any conference calls or Zoom meetings that we can do with you. We promise we're going to make you look really good. Having that co-pilot that's really going to go through the differences, right? Maybe you want to look at a traditional for a client and a linked benefit, and we can really navigate through. Here's your differences, Mr. Client. Here's why we quoted what we quoted. Again, and our key is to help you help them, protect their assets and their legacy for their loved ones. So with that, I'll come up for air. And Bob, do we have any questions?
No, but can you repeat all that, Melissa?
No, but you can definitely go out to advisorsiv.com into our archive training section.
That's right.
Next week, and you can watch it all over again.
That's right. Yeah, as a reminder to everybody, it'll take us a day or two, but then out on our archive training page, if you joined us late, we'll be adding this recorded training session to the ones we have out there. Advisorsiv.com is our website. You can see it in the bottom left in Melissa's slides. Then just go to tools and resources, and archive training will have this as well as a bunch of our other training out there here within the next day or two. We do have a couple of questions, Melissa. Jack is asking, what is the most common payment option for linked benefit plans? I presume he means premium payment options.
Yeah, so it really depends. I would say certainly 10 pay is probably most common, Jack. I think it definitely has to do more so with age. A 10 pay premium might look pretty darn attractive for someone who is young, but it might not look quite so attractive for folks that are older. It also depends on their premium threshold. Can they afford, say, $10,000 a year for 10 payments? Or do we need to pull that out and have that last longer? So I would say 10 pay, and I think Jen would agree with me, is probably most widely purchased, but we are certainly doing more single pays, especially if there's 1035 funding available. And again, stretching it for those that are cost conscious and doing like a pay to 95 or pay to age 100.
I know too, Melissa, and we've got people from all over the country here as I'm looking at some of the people that are on today, but in particular in New York with the new Care Matters 2 product, are you seeing an uptick in the lifetime premiums on that product, especially at the younger ages, with how favorable they can match up with even a traditional plan?
Yeah, we are, which is the very reason that I wanted to show that slide of folks who are younger, just to show that it really can be affordable. Yeah. For people to really start to plan earlier and earlier. Definitely we're quoting the pay to age 100. Certainly I am nearly every day, but I'd say it's a healthy mix between pay to age 100 and a 10 pay.
Good deal. Mark is asking, can you 1035 exchange an existing life policy into the Nationwide Care Matters 2? You
sure can. I alluded to that, so I'm not sure when exactly you asked that question, Mark, but you certainly can. Definitely let us know what that 1035 money is. We can put it into the software. And if a client wants to throw a little extra gravy on top of the 1035 to give it even a more hearty monthly benefit for long-term care, absolutely. We do it all day long. And I think for Mark and others, let's face it, there is a ton of life insurance out there that has no long-term care or chronic illness benefit attached to it, that if you just go out there and have that conversation, maybe they bought their life insurance when the kids were younger, they had a bigger mortgage or a mortgage, and they don't have a mortgage anymore, or a much smaller mortgage. The kids are out of the house, but they've done no extended care planning. The power of being able to use 1035, as Melissa would attest to, is really great. So yeah, we should be having that conversation for sure. Esther's asking, can you tell me what your favorite carriers in California might be for long-term care insurance and linked benefits? Sure, Esther. It really doesn't change very much. Outside New York, we certainly do have National Guardian Life. They're a little newer to the space. Their features aren't quite as robust, they do have their cells. They look good with shared care. Sometimes they can be a little bit more tolerant depending on the medical situation, but I would say certainly traditional long-term care, without a doubt, Mutual of Omaha still tends to be our leading carrier. And on the linked benefit side, really a great deal. I would say that Nationwide probably wins 9 times out of 10, regardless of state. On the linked, One America happens to be definitely in second position. For those folks that they also have a second to die joint contract, you can also do a lifetime benefit period. We didn't really talk about that. And they are quite a bit more forgiving. I wouldn't say back up the dump truck, but they're definitely more forgiving in underwriting than, say, a Mutual of Omaha and a Nationwide. So as far as the carrier, I'd say spend more time on the pre-qual and their financial ability as far as how much can they put into the insurance product. And Jen and I can certainly help you determine who that best carrier for that flavor is.
Well, I think you've hit on the key there, Melissa, and I would say this to Esther and everybody else, that's the power of having Melissa and Jennifer here. They'll compare for you because at a certain age or demographic or health situation, this carrier might be the best or at least the best fit. For a different age and a different health situation or different goals, this other carrier might be best. We'll do the heavy lift for you. We'll help you determine what might be the best fit in every situation. Got a follow-up from Esther. She wants to know, how trusted is the company behind True Freedom? My client is wary of them because they've never heard of them and worry if they can pay the claim in the future.
That's a great question. And I wish we had the crystal ball, right, Esther? I mean, we never know if AAA is going to be there for us forever or any of the other discounted programs that we may participate in. But I can say this. It's a definite different demographic. You know, the average on an insurance product, like a Mutual of Omaha or Nationwide, right? The average buyer, as I mentioned, is in their mid-50s. So that client isn't claiming for, God, 20, 25, 30 years, God willing. However, it's definitely a different animal with True Freedom. You know, the people that are enrolling into True Freedom are well into their 70s, if not 80s. And they probably wouldn't love me if they heard me say that you might have a foot on a banana peel. And you may need this in the foreseeable future, year, 2, 3 years, because your health is declining a bit and the writing is on the wall. And so some things give me some comfort, one of which is that we're not worried about a company that isn't going to be here in 20 years. We want to make sure they're going to be here in 2 or 3 for the most part. But you also want to take into consideration that the viability of the company. They are A+ rated by the Better Business Bureau, and they have been writing this program since 2006. So it's been 20 years, and they're sitting on the exact same rate schedule that they had from the jump. So knowing that there's been that many years that they have paid claims and paid lots of them, okay, because again, people are claiming so quickly that the reality is, while we don't have a guarantee, we can't give them that absolute guarantee that they will be there for them. But my proposition to them is, what other choice do they have? They may not have any other choice. And to me, if I could potentially transfer the risk of $240,000 in my example to somebody else, I'm going to take my chances that a year, 2 or 3 years down the road, they're going to be there when I need them. So a little bit all over the place, Esther, but I hope that helped you.
Got it. Kathleen is asking, what is an IADL? Yeah, and I think she is referencing in the context of True Freedom.
Yes. So absolutely. So long-term care policies cover us, of course, for activities of daily living, but they also cover incidental activities of daily living, which are akin to things like homemaker or chore services. And so that said, you can't just need chore services to get, say, benefits out of Mutual of Omaha or out of Nationwide. You actually have to first trigger with an ADL loss or a severe cognitive impairment loss what's nice about the True Freedom is you could conceivably be able to do your activities of daily living just fine, but you want someone to come in and, maybe one ADL you need help with, but you want somebody coming in to help you cook and clean and take you to your medical appointments and things like that. So that's IADLs as incidental, or again, chore services or housekeeper type of skills.
Okay, great. Thanks, Melissa. Esther's got two more. Can you send us the pre-qual form? Which I know the answer is yes, but so maybe we can get that out to everybody. And then
Absolutely.
do you have any, she says SOSMED. I think that might be maybe a misprint unless I'm misreading it. Do you have any SOSMED video or photos about LTC we can use? Sounds like maybe marketing material, something they can use in an HTML or video format.
Yeah, I mean, I don't have anything specifically in video format on long-term care in general. We definitely have articles, we have some marketing brochures that we could certainly send out. A couple of them are customizable. Definitely the True Freedom video to learn more about it, which is for you and also for the client. It's a consumer approved video specifically on True Freedom, and I highly recommend that link, and I can get that out to everybody as well.
Bottom line, Esther, we can certainly help with some marketing collateral for whatever context you might be looking at it for. Dan says you did a horrible job. That's a joke. Dan said Melissa is always terrific, and he's absolutely right. David asked, how is True Freedom rated? So maybe you just want to touch on that real quick.
They're not rated in the context of AM Best or Standard & Poor's because they're not an insurance company, but they are A+ rated by the Better Business Bureau. And if you want to learn a little bit more and take a deeper dive, it's truefreedomhomecare.com is their website. So feel free to peruse their website and get a little bit more familiar with them.
Sounds good. And Esther is clarifying social media is what she meant by SOSMED.
Gotcha.
Didn't get the
yeah, I believe Mutual of
shorthand.
Omaha does have some social media stuff on their website, Esther. So certainly get with me and I can reach out to them because I'm fairly sure I have seen some collateral from them maybe last year on some social media content.
And then we got a couple on the chat, it looks like, Melissa. So thank you, Melissa. Very helpful. Jackie said, great presentation. Thank you, Melissa. David, always informative. Appreciate the support that you and Chris Scott, that is, and team provide. Robin is asking, excellent presentation. Thanks, Melissa. Regarding True Freedom, I like that you are buying hours and not dollars, recession proof. And she meant inflation protection. She said not recession. So good stuff. Jackie is also asking, can I get the True Freedom link, please? So maybe we can include that in some follow-up information that we might send out.
Sure will.
And those appear to be all the questions that we had. So, and we're over time, but for good reason, Melissa. Great job as usual. Any final comments before we cut everybody loose? Obviously, everybody, if you do have follow-up questions, even though we're wrapping up, Melissa will be happy to take those after the fact. You can see her email right there on the screen and her phone number.
Yeah, please just lean on Jen and I. Collectively, us two girls, we have 60 years of long-term care experience between the two of us. So lean on us, let us help you design a plan, pre-qual those cases up front. We can jump on conference calls, Zooms, and help run co-pilot with you. So anything we can do, but bring it up. The key is don't be afraid of what you don't know. Because if your clients haven't, if you haven't brought up long-term care protection to them, somebody else will. And I get that a lot. I'll get agents that come to me every week with a copy of a quote. And I have all I can do not to go, shame on you. What do you mean? Somebody else beat you to the punch. So definitely make sure you're proactively bringing it up and we'll figure it out together. We'll make you look good. We'll make you comfortable with it. And it can really add some significant revenue for sure, with long-term care.
Appreciate it. And just to clarify, Melissa did say 60 as in 60, because both she and Jen started when they were how old? Single digits, Melissa?
I always say 8 years old. but no, we each have 30 years.
Scary.
You know, it is
Scary.
pretty scary. So lots of
All right,
experts
Melissa.
at AIB. So thank you
Great.
everyone so much for spending the last hour with me. I truly do appreciate it. And I so hope that I can help you help your clients really soon.
Thanks, Melissa. Appreciate it. Thanks, everybody. Take care.
Bye-bye.